Good afternoon, ladies and gentlemen. The Monetary Policy Committee (MPC) held its 262nd meeting on Monday the 23rd and Tuesday the 24th July 2018 amidst fragile improvements in global growth and fragile domestic economic recovery. The committee reviewed developments in the global and domestic economic and financial environments, as well as the outlook for the rest of the year. The MPC also assessed the risks to price stability, credit growth, employment creation, and financial system stability in the short to medium term. 10 members of the Monetary Policy Committee were in attendance. Global economic developments. Global growth momentum remained promising despite rising trade tensions, Brexit concerns, and improving developments in the Korean Peninsula. Global growth was projected at 3.9% in 2018, compared with 3.7% in 2017, largely driven by the recovery in oil prices, accommodative monetary policy, and increased consumer spending in some advanced economies. In the advanced economies, growth was projected at 2.4% in 2018, the same as in 2017. The projection was expected to be driven majorly by fiscal stimulus in the United States, coupled with accommodated financial conditions in advanced economies. In the emerging market economies and developing economies, output growth was projected at 4.9% in 2018, up from 4.7% in 2017, due largely to sustained recovery in global commodity prices, particularly crude oil, rebound in investments, manufacturing and trade, as well as the strengthening of domestic consumption. The downside risk to global output growth remains the build-up in financial vulnerabilities, rising cost of borrowing in emerging markets and developing economies, fragile corporate balance sheets, escalating trade protectionism, uncertainties around the Brexit negotiations, heightened geopolitical tensions, and fiscal sustainability concerns. Global inflation was predicted at 3.2% in 2018, driven by rising energy prices and currency depreciations in some emerging markets and developing economies. In the advanced economies, inflation was projected to increase to 2.2% in 2018, up from 1.7% in 2017, as a result of increases in the cost of transport, housing, energy, and food. Similarly, inflation in the emerging markets and developing economies is projected to rise from 4% in 2017 to 4.4% in 2018 due to currency depreciations and rise in energy prices. The committee believes that global inflation is likely to remain subdued over the medium term relative to long-term trends, despite subsisting monetary accommodation in some advanced economies. Domestic output development. Economic recovery was sustained with a positive outlook over the medium term, anchored on oil price recovery, fiscal spending, and stability in the foreign exchange market. Data from the Nigerian National Bureau of Statistics (NBS) showed that real gross domestic product (GDP) grew by 1.95% in the first quarter of 2018, compared with 2.11% and a contraction of 0.91% in the preceding and corresponding quarters of 2017, respectively. The oil sector, which contributed 1.26% in 2018, compared with 0.76% during the fourth quarter of 2017, was the major source of the growth. The Purchasing Managers Index for manufacturing and non-manufacturing activities rose for the 15th and the 14th consecutive months to 57 and 57.5 index points respectively in June 2018. The committee noted the positive impact of the sustained improvement in foreign exchange supply on the performance of manufacturing and other key sectors of the economy. The committee welcomed the positive economic growth, but observed that the recovery was still fragile and called for the speedy implementation of the 2018 federal government budget and the economic recovery and growth plan to strengthen output growth in the Nigerian economy. Developments in the money market. The committee observed that narrow money M1 contracted by 4.25%, annualized to minus 8.49% compared with the provisional benchmark of 8.04%. Broad money supply M2, however, grew by 2.79% in June 2018, annualized to 5.58% compared with the provisional growth benchmark of 10.84% for 2018. The increase in M2 was mainly driven by the net foreign assets, which grew by 18.15% in June 2018, annualized to 36.3% compared with the provisional benchmark of 18.15% for 2018. The development reflected the improvement in foreign receipts arising from favorable crude oil prices. On the other hand, net domestic credit contracted by 1.4% annualized to minus 2.8% compared with the provisional benchmark of 12.45%. The development was driven largely by increase in net credit to government, which contracted by 9.74% in June 2018, annualized to minus 19.48% against the provisional benchmark of 54.97%. Credit to the private sector similarly contracted by 0.04%, annualized to minus 0.08% in June 2018, in contrast to the provisional annual benchmark of 5.64%. A revised and seasonally adjusted money supply aggregate, however, showed an uptick. The new aggregate M3, which is still being finalized by the bank, appears to comprehensively capture the liquidity in and outside the banking system compared with the existing M2. More details about the impact of M3 on macroeconomic variables will be reviewed at future MPC meetings. Headline inflation year on year trended downwards for the 17th consecutive month to 11.23% in June 2018 from 11.61% in May 2018. Food and core inflation also fell to 12.98% and 10.40% from 13.45 and 10.71% respectively over the same period. Committee, however, noted the rise in the inflation rate to 1.24% in June from 1.09% in May 2018. Food inflation month on month also increased from 1.33% in May to 1.57% in June 2018, representing an increase of 0.24 percentage points. During the same period, core inflation month on month also rose by 0.05 percentage points, 0.98% in May 2018 to 1.03% in June 2018. In view of the trend in rising month-on-month inflation rate, amid the slowly declining year-on-year headline inflation, indications are that inflationary pressures are rebuilding in the domestic economy, and dealing with this requires further impetus in the future. The review of developments in the money market revealed that the average interbank call rate fell to 5% in June 2018 from 25.43% in May 2018, while the average open buyback OBB rate decreased from 18.37% in May to 10.84% in June 2018. The trend in market rates and the net liquidity position reflected the impact of the auction of open market operations bills, foreign exchange interventions, FAC allocations to various levels of government, as well as the servicing of maturing CBN bills. External reserves stood at $47.2 billion on June 23, 2018. The committee was optimistic and expected further increases in the level of external reserves in the near term, citing the favorable crude oil prices. The committee therefore advised the bank to sustain its current efforts to maintain investor confidence and ensure accretion to external reserves. The MPC also called on the federal government to continue to build fiscal buffers against possible oil shocks in the future, noting that the rise in the monthly distribution of revenues at the FAC portend the danger of having reserves buffers to absorb shocks in the future. The oil share index increased marginally by 0.09% to 38,278.55 on June 29, 2018, from 38,243.19 at end of December 2017. Market capitalization increased by 1.89% to 13.87 trillion naira on June 29, 2018, from 13.61 trillion as at December 2017 year end. However, oil share index and market capitalization fell by 7.24% respectively and on June 29, 2018 compared with the level at end of April 2018, due majorly to profit-taking activities of investors and the effect of monetary policy normalization in some advanced economies, especially the United States. The committee noted with satisfaction the relative stability in the foreign exchange market and high level of activities, particularly at the investors and exporters window. Committee noted the commencement of the currency swap deal with the People's Bank of China and noted that the availability of renminbi currency to Nigeria investors would ease pressure in the foreign exchange market. The MPC called for speedy implementation of the framework of the currency swap and urged the bank to carry out sensitization of the Nigerian public. The overall outlook and risks to the domestic economy. The forecast of key macroeconomic indicators points to a positive economic growth in the second half of 2018. The expectation is premised on the implementation of the 2018 budget, sustained stability in the foreign exchange market, as well as increase in crude oil production and prices. The MPC cautioned that the downside risk to the growth outlook to include continuing delay in the implementation of the 2018 budget, worsening farmers and herdsmen conflict in some parts of the country, continued non-payment of workers' salaries and pensions in some states, rising sovereign debt, as well as uncertainties surrounding the direction of trade policy, including the external demand for Nigeria's oil. Inflation forecast for the near term points to further moderation in price level. However, the downside risks to inflation include the impact of excess liquidity that could arise from the implementation of the approved 9.1 trillion naira 2018 federal government budget, pre-election spending, anticipated review of salaries and wages, security challenges, and monthly FAC injections. These could boost aggregate demand, but would equally exert an upward pressure on domestic prices for the rest of the year. The committee therefore called for a coordinated fiscal, monetary, and exchange rate measures to stem the buildup of price pressures. The committee observed that rates in the foreign exchange market have remained relatively stable in the near term, supported by continued intervention in the market by the bank, sustained high increases in the price of crude oil in the international market, as well as positive developments in external sector. The continued bearish trend in the capital market, due largely to profit-taking activities by investors and monetary policy normalization in some advanced economies, requires a careful mix of policies to stem capital flow reversals. The consideration of the committee. The MPC noted with satisfaction the fourth consecutive quarters of growth in real GDP and the positive growth outlook in the domestic economy. This is shown by the sustained improvement in the manufacturing and non-manufacturing purchasing managers indices in the second quarter of the year. The MPC commended the approval of the 2018 federal government budget and called for an accelerated implementation to further support the fragile growth recovery. Committee also called for sustained implementation of the Economic Recovery and Growth Plan (ERGP) to further stimulate output growth. MPC was, however, concerned about the liquidity impact of the 2018 expansionary fiscal budget and increasing FAC distributions due to rising prices of crude oil, as well as the build-up in election-related activities. Notwithstanding the positive direction of the outlook, the MPC reviewed the effects of the sustained monetary policy normalization in some advanced economies, with implications for capital flow reversals, exchange rate and domestic price pressures, as well as other challenges to growth during the second half of 2018. The committee took note of the sustained moderation in inflation pressure, especially deadline inflation, as well as stability in the foreign exchange market, but expressed concern on the threat posed by the incessant herders and farmers' crisis in some key food-producing states, the negative impact on food supply chains, which would continue to exert upward pressure on food prices. The committee therefore called on the bank to continue to build on the progress already made in arresting the trend to sustain the moderation in inflation. The MPC also observed with satisfaction the high level of activities in investors and exporters window of the foreign exchange market, which continue to supply liquidity in the foreign exchange market, narrow exchange rate premium, and reduce speculative activities in the market. The MPC noted the continued improvement in the performance of deposit money banks and expressed optimism that the moderation in the levels of non-performing loans in the industry would continue. The committee therefore called on the federal government to accelerate the settlement of outstanding contractor debts and also encourage the bank to ensure strict compliance with regulatory provisions. In discussing the economic report presented to the members, it was observed that as the prices of crude oil prices in 2017 and 2018, the monthly allocation to various levels of government also increased, suggesting that federal government was not conscious of saving for the rainy day. The committee therefore advised the fiscal authorities to build buffers, especially now that the price of crude oil is relatively high. Committee's consideration. Informed by the developments in the global and domestic economic financial environments, the committee painstakingly reviewed the policy options available. In particular, committee considered the sustained positive growth in the real gross domestic product over the last quarter, stability in the foreign exchange market, high level of accretion to external reserves, as well as the deflationary trend. The MPC deliberated on the rise in food inflation, impact of the expected liquidity from the expansionary 2018 federal government budget, and rising FAC disbursements in the second half of the year, along with the buildup of pre-election spending. The committee strongly considered the option of tightening, believing that tightening would curtail the threat of a rise in inflation, even as the injection from the fiscal authority will still provide the economy with substantial liquidity. Notwithstanding the deceleration in inflation, in headline inflation, the current double-digit inflation rate remains above the bank's 6 to 9% target range. In addition, the committee is of the view that tightening will help stem the tide of capital flow reversals in the face of sustained monetary policy normalization in some advanced economies. This, the committee believed, would rein in inflationary pressure and moderate inflation rate to single-digit levels, increase real interest rate, build investor confidence with attendant positive impact on capital inflows, and further stabilize the country's exchange rate. On the contrary, the committee is of the view that raising interest rates at this time would weaken consumption and raise the cost of borrowing to investors in the domestic economy. In addition, the policy would trigger repricing of financial assets by deposit money banks and further constricting to the real sector that would promote non-inclusive growth without development. In considering the option of loosening, the committee assessed the potential effect of stimulating aggregate demand through lower cost of capital. This could stimulate consumption and aggregate demand. The committee, however, considered its potential relevance, taking into account the expected liquidity injection from the 2018 budget, increased FAC disbursements, and election-related spending ahead of 2019 general elections. If this crystallizes, it will exacerbate inflationary and exchange rate pressures, as well as return real interest rate into negative trajectory. Moreover, lowering policy rates may not translate to an automatic reduction in market rates due to poor transmission mechanism owing to structural rigidities. The committee is also of the view that loosening could reverse the gains already made with reduced importation, which has strengthened the current account balance. It will also lower banks' risk appetite and possible rise in NPLs, which could negatively impact on the banking industry stability. In the discussion for a hold, it was noted that risks to the macroeconomic and financial environment appears fairly balanced, with improvements in output growth at 14% since July 2016, and considering the dynamic nature of the market, the rate might have lost its signaling effect on the market, hence dampened market expectations. The argument in favor of maintaining the current policy stance is to monitor the magnitude of the liquidity impact of the fiscal injections and election-related expenditure ahead of the 2019 general election. Overall, Monetary Policy Committee was of the opinion that while it is difficult to encourage job creation in an environment with deficit in infrastructure, the committee believes that the bank should continue to encourage deposit money banks to increase the flow of credit to the real economy to consolidate economic recovery. In this regard, the committee believed that a heterodox approach to reform the market to strengthen the flow of credit would be appropriate at this time. Consequently, credit-constrained businesses, particularly the large corporates, are encouraged to issue commercial papers to meet their credit needs at low interest rates and possibly single-digit rates, and the CBN may, if need be, buy those instruments to complement the efforts of the deposit money banks. In addition, as a way of incentivizing deposit money banks to increase lending to the manufacturing sector and the agric sector, a differentiated dynamic cash reserve requirement regime will be implemented to direct cheap long-term bank credit at 9% with a minimum tenure of 7 years and 2 years moratorium to the employment elastic sectors of the Nigerian economy. Details of this framework are being worked out by the Banking Supervision and the Monetary Policy Department and Research and will be released very soon. In consideration of the foregoing, therefore, the committee decided by a vote of 7 members to retain the monetary policy rate at 14% alongside all other policy parameters. 2 members, however, voted to increase the MPR by 50 basis points, while 1 member voted to increase the MPR by 25 basis points. Consequently, the MPC voted to retain 1. the MPR at 14%, 2. CRR at 22.5%, 3. liquidity ratio at 30%, 4. asymmetric corridor at plus 200 and minus 500 basis points around the MPR. I thank you for listening.